Topic 3, Global Financial Markets Part 1. What I mean by global financial markets is basically what we call in macroeconomics debt markets. So we're going to introduce the first type of debt instrument and learn about those particular debt markets and also the interest rates on those types of debt as well. So when you think of global financial markets, you may think of stock markets and other types of asset markets, because global financial markets are obviously big and complex. We're sort of narrowing it down and looking mainly at debt markets. We'll mention stock markets in passing, but certainly when you're talking about global financial markets, it's really debt markets and stock markets that are the two major markets globally. So the first topic here, 3.1, we're looking at the difference between direct and indirect finance. Let's start off with indirect finance. This should be fairly familiar to you because what we've got is a lender lending money to a borrower. So a lender lending money to a borrower through a bank. Now, you may well participate in this market. If you've got a car loan, you'll be a borrower. If you've got a mortgage, you'll be a borrower. However, if you've got money in a savings account, you'll be a lender. If you've got money in a term deposit, you'll be a lender. Now, generally, when we're talking about indirect finance, we are talking about transactions which are smaller in size. So a lender might typically lend $1, $2, $5, $10, $20,000. A borrower might borrow up to a couple of million. Okay, just imagine you're looking at buying a house. You would be a borrower and you'd be borrowing that money from a lender via the bank. Okay, so yes, you do borrow the money off the bank, but we're asking the question, well, where does the bank get the money from? Well, the bank must get it from another lender. And so if you're borrowing money to purchase a house, how much is that mortgage going to be? It's unlikely to be $10 million. It's going to be a few $100,000, maybe up to $1 million. That's what I'm getting at in terms of these sorts of transactions being smaller in size. In comparison over here under direct finance on the left here, the transactions can be in the millions or billions of dollars. So this is the sort of market, or this is the sort of finance, indirect finance, that you and I participate in. So if we need money to finance a house purchase, a car purchase, it could be a student loan, anything like that, generally we will be a borrower and we'll be borrowing the money off the bank. Now, just for now, we're going to assume that when a bank obtains money to lend to a borrower from its customers. So customers come into the bank and put money or leave money in their savings account or put money in perhaps a term deposit. And then the bank takes that money and lends it to a borrower at the same bank. Now that is overly simplistic because Australian banks, of the lending that they do to borrowers, around about 60% of that money, 60, 62%, comes from customer deposits, money in savings accounts, term deposits, things like that. So the other 38 to 40%, banks get it from another source, but we're not ready to go there yet. We will very soon. But just for now, I just want to emphasize that indirect finance involves a bank. Now, it'd be interesting to ask yourself, well, why, if I'm undertaking a mortgage and I'm a borrower and I want to borrow $1 million for a mortgage, why can't I directly go to a lender? Why do I have to go through the bank? Interesting question. And that'll probably come out later in the course. But one obvious answer would be transaction costs. Transaction costs are the costs of actually undertaking a transaction. So if you wanted to borrow $1 million, imagine you're sitting there, you've picked the house, and now you need $1 million, but you don't want to go through the bank. How are you going to find someone who has $1 million to lend. That would be a massive transaction cost for you. What are you going to do? Advertise on the internet? That's crazy. People don't do that. But how would you find that person? That alone shows you why banks are so vital. Because I don't know where you'd find the person on the other side of that loan if you didn't go through the bank. But we'll leave indirect finance there. I just need you to know that it exists. In this topic and topic 4, we'll also explore global financial markets in topic 4. We're not really interested in this type of finance. We're more interested in this type of finance, indirect finance. Now, whereas direct finance over here on the left, that's what we're interested in. So whereas indirect finance is all about people lending and borrowing small amounts and a bank helping those people transact. And while this is called, generally speaking, retail money markets or retail banking, we're more interested in here. There's no bank in the middle. There's no institution in the middle. The lender is lending directly to a borrower. The transactions are generally massive, in the millions, tens of millions, hundreds of millions, or billions of dollars in one transaction. And it's called direct finance because the lender is directly lending money to the borrower. So whereas over here on the right, you may be the lender and I may be a borrower, who are the lenders and borrowers in these wholesale money markets? Okay, so this is retail banking or retail money markets. This is wholesale markets. So who are the lenders and the borrowers? The lenders and the borrowers, let's just keep it simple. Think of them as big institutions. So banks, Westpac, ANZ, Commonwealth, they can be lenders, borrowers. The Australian government can be a borrower. The Reserve Bank of Australia can be a lender. And if we're considering these sorts of markets in Australia, then we may actually have the Bank of Japan being a lender. We may have a hedge fund in America being a lender of money into this market. We may have a superannuation fund in the UK being a lender. Generally, the borrowers will be Australian because the transactions will be in Australian dollars. So if you're a borrower in this market and you're borrowing in Australian dollars, then obviously you want to spend those Australian dollars. So generally the borrowers would be borrowing money to spend that money in Australia. So generally speaking, although not exclusively, the borrowers tend to be Australian institutions. The lenders, they can come from anywhere in the world. So who are the big borrowers? Australian banks, other big companies, the Australian federal government, the Australian state government. So they're the sorts of organisations that we're talking about. I just like to keep it simple and think of the borrowers as being banks, other big companies, and various branches of the government, let's say state and federal. Whereas the lenders, they're much more diverse. They could be local organisations, they could be foreign organisations. So for example, when you put your money into a superannuation account, that superannuation account will invest that money on your behalf to try to earn a return. Some of that money may actually be loaned, as the superannuation fund is now the lender. The superannuation fund may loan some of that money to the borrower. In fact, it could be loaned to the Australian federal government, Woodside, BHP, Wesfarmers. Could be loaned to the Commonwealth Bank, National Australia Bank, AMP. They could all be borrowers in this market. Now, in these markets are what we call debit markets. Debt markets. It's a little bit late in the day for me. So debt markets. And so when the lender lends money to the borrower, obviously a debt is incurred. And we're going to break these debt markets up into short-term debt markets and long-term debt markets. And short-term debt markets is the topic of, or the subject of topic 3 in this course. And long-term debt markets are the subject of topic 4, the next topic. So what we have here, remember, we're ignoring indirect finance. What we have here, big lenders, big borrowers, millions of dollars being loaned in one transaction, sometimes billions of dollars in one transaction. These are markets that you probably haven't heard of before. You haven't seen them in operation, but they're lying behind the financial system. And of course, plenty of Australians work in these markets. We've got bond traders. You may have heard of people working as a bond trader. They will be working in these long-term debt markets. Now, with these debt markets, we have split them into short-term and long-term debt markets. Generally speaking, short-term debt markets involve a loan from a lender to a borrower, large amounts of money, anywhere from 1 day up to about 1 year. And long-term debt markets involve a loan anywhere from a year up to 30, 40, 50, even 100 years. I have seen loans as long as 100 years. Okay, so that's the difference between direct and indirect finance. Now, we will be coming back and talking more about indirect finance, that is, what affect interest rates such as mortgage interest rates that the banks charge, what affects interest rates such as small business loan interest rates, car loan interest rates, student loan interest rates. They are all loans initiated by banks, and they all have interest rates attached to them. So we'll be coming back and talking about these later. But for now, we're not very interested in indirect finance. It's all about this direct finance. Now, just keep in mind who the lenders are, who the borrowers are. Big institutions, big organisations. And keep this split between short and long-term debt markets in mind as well. Okay, so that's the end of topic 3.1, and in the rest of this topic, we will be drilling down into these short-term debt markets and learning exactly how they operate. Why is that important? Because the Reserve Bank of Australia implements monetary policy in Australia through short-term debt markets. That is how interest rates have changed, through these short-term debt markets. And we need to establish what these debt markets are all about before we can fully understand how the central bank changes the cash rate and how any changes in the cash rate flow on and affect other interest rates and ultimately the aggregate demand curve. So I'll leave it there.